Okay, today is day 11, and really today is all about how to underwrite or do a BOE, back of the envelope, on a commercial real estate property. So, what I thought I would do is I'm going to actually do an actual deal breakdown. But first, what I thought I would just kind of zoom back out really quick, just so that um, we kind of we know where we're at in this journey, if you will, right? Because this isn't this is kind of a sequential step by step process. So I've kind of titled it like, how much money do you need to retire? I mean, obviously everyone has different goals, but usually retirement or sending their kids to college is kind of the two major ones. Um, okay, so step one is really understanding where you're at and what your current truth is, right? So that is, what's your net worth, where are your assets, what's your cash flow, what's your run rate? We've already done that. Step two is, where do you want to get to, right? What is it that you're striving for? And where do you want to eventually get to? And that this line might be 1 year, might be 5 years, might be 10 years. How you like inside of this, if you will, from point A to point B, is understanding why you want to get there. Now, I'm not going to get into that today because that's really like an in-depth, you know, um, process, if you will. But the more clear you are on why you want it, it will pull you through when there's challenges in a deal. And then um, just this is just kind of how do I put it? Uh, Really to kind of emphasize, if you are looking for, say, $180,000 a year, if you believe you're going to earn 6% a year, you're going to need liquid assets, not liquid, but you're going to need assets that are producing 6% a year, worth $3 million to achieve 180,000. Now, how we achieve that, the strategies, is generally where most people, if you're not familiar with commercial real estate, you don't know how you're going to find an asset that's going to pay you 6%, right? Especially with low risk, or, risk that you would accept. So this is actually a property that I was pursuing in Phoenix. I'm not going to get into the details. It was just too small for me. But these are like very close numbers without giving away, too much information, if you will, because what happens generally, just so you understand why I don't give like specifics, is usually I'm signing like NDAs or CAs where I can't disclose certain information. So just to respect brokers and whatnot, I don't give out addresses and I don't give out specifics. But this was a real deal. It was just too small for me. So it's going to be a retail property. And just to give you some context, the formulas that we're going to work on today are NOI, net operating income, which is really income minus expenses. Two is cash on cash, which is your net operating income, NOI, minus your debt, divided by how much money you put into the deal, which is called your equity. And then number three is your cash on cash with equity pay down. So just think of that as, if you bought a property with a mortgage, every year, as long as you're paying principal on the mortgage down, you're gonna reduce your mortgage. So that's called cash on cash with equity pay down. And the simple formula there is NOI plus your principal pay down minus your debt payment divided by your equity. That's going to give you your cash on cash with equity pay down. So what I thought I would do is just give you kind of a simple example here. So when you're doing a BOE, I see one of the biggest challenges I see with new investors is they will break out these, very intricate Excel spreadsheets. And generally what happens is they get really kind of caught up in the details. And all I'm really looking for is, okay, what's the purchase price? How big is it? What's the NOI, right? To calculate the NOI, you're really just figuring out so NOI is income minus expenses. So how do you calculate the income? Step one, what are your rents and what is your other income minus vacancy? I mean, I'm trying to keep it as simple as possible. Obviously, when you get into more complicated structures, and a financial analyst will do, they'll be looking at income today, but really the challenge, if you will, is figuring out what the income in the future will look like. But we're not going to worry about that today. All we're worried about is how do you do a back of the envelope on today's income? Step one, what's the income, right? So I've already given it to you, the NOI of 90,000. Now, what I didn't give you is I gave you how big the property was, right? So you could figure out very quickly what's the rent per square foot. You would just go $90,000 a year divided by 12,000 square feet. That's going to give you your rent per square foot. But you don't know if it's 100% full. You don't know if there's vacancy. And on the second page, which I'm not going to get into today because it's way more advanced, that is when we start to assume that maybe there's 20% vacancy. We take into consideration slippage, which is your operating cost that you're not recovering because it's vacant. But what I thought I would do literally is just kind of keep it, like I said, as simple as possible. So if we know our purchase price, the size, NOI, you don't really need to know the size, but I find it's helpful. You figure out what the cap rate is, right? And all the cap rate was, just to refresh, is you're just doing your NOI divided by your cap rate, right? So your NOI is, well, actually, we're calculating the cap rate here. So basically, you're taking your NOI divided by your purchase price, and that's going to give you 7.5%. Okay, so there's that formula can be modified, but if you just go 900 or 90,000 divided by 1.2 million, you're going to come up with a 7.5% cap rate. And step two, if you will, once you've got your cap rate, is how do we put debt onto this property? So in this situation, I'm assuming 70% leverage, a 4.25% interest rate on a 25-year RAM. So I'm going to get $840,000 of debt, okay? Which means I'm going to need $360,000 of equity. Now, I know that we could get into the details of what were my closing costs and due diligence and mortgage fees and whatnot. But the reason we do a BOE is it's just a very high level, quick and dirty number, right? We're not going to account for everything. If you wanted to, you could certainly say, okay, equity of 360 plus another 50,000 for closing, something to that effect. If you wanted to be a little bit more disciplined in your underwriting, but for this, we're just going to keep it simple. Now, to calculate your principal and interest payment, I've already done it, but really all I use is this calculator right here. I think it's an HB2 Plus, something to that effect. You can actually get an app on your iPhone. I would just Google, like I've been doing it so often that it's very simple for me, but the calculations and the inputs are not that difficult. And I think the app on a phone is maybe $30 and it's well worth it. I use it all the time, but I still like having kind of the physical calculator here. Okay, so NOI 90,000. My principal and interest is going to be 54,000. My cash on cash is just 90,000 minus 54,000, 35,000. So that's going to give me a 9.83% cash on cash. Now, if I wanted to do cash on cash with principal pay down, I would just calculate how much principal I've paid down in year one and add that to 35,000. Let's just say it was, I'm gonna, I don't know, it's probably about $20,000, 25,000, I'm assuming, based on this 54. So 35 plus 25 is going to be 60. 60 into my equity of 360 will give you your cash on cash with equity pay down. So you can see that, you know, a 9.83% on a going in basis is a decent cash on cash return. Here's what I want to emphasize. Your cap rate of 7.5% and the spread between the interest rate of 4.25%. That's why you've got this, what's called positive leverage. If my cap rate was 7.5 and I was borrowing at 7.5, what would generally happen is you're going to have negative leverage, it's called, because you have principal that you're paying down. If it was an interest only loan at 7.5%, it would be a wash. But if you're paying principal, generally what's going to happen, well, not generally, it will happen that your payments on an annualized basis will, it's kind of challenging to explain, but it's just negative leverage means that you're better off almost to pay all cash, if you will, if you're not factoring in how much principal you're paying down on an annualized basis. So really the key is look for this spread, right? Usually 2% is kind of a nice delta, if you will. So right now, as I'm recording this in whatever it is, March 5th, 2020, bonds have really come down and compressed, which means you can borrow for much less. I mean, I just met with our bank and we're talking about 3.1% interest rates for takeout financing on a development that I have. Well, at 3.1%, I initially was underwriting at 4.25. So if I'm saving a full percentage point, I can either get more debt, or the debt that I'm going to borrow becomes much cheaper, which means my returns go up significantly. So I think right now, certainly look, I don't know what's going to happen in the future, whether or not we're going to have a serious correction. But I can tell you in commercial real estate, the way properties are valued, when interest rates get lower, and this is what you've seen over the past 10 years, interest rates have continued to compress. And generally what that does is it pushes values up, right? All else being equal. So hopefully that helps. I mean, this BOE is a very streamlined way to underwrite a property. And I think that if you just keep it as simple as possible, it's really going to help you in your underwriting and evaluating deals, right? I would do something like this literally on a piece of paper, right? Just something like you could probably put it on something that small. And what it really does is it gives you an idea. Am I going to put more time into this deal, right? If I found out that this was like a 6% going in cash on cash, maybe that's not enough for me. Or this could be like a core multifamily asset that I really want to own. And I look at it and I say, okay, you know what? I'm okay with a 6% return. This goes back to risk, reward. What are your goals, right? What we talked about on the other page there, and why the type of properties that you're going to be looking for are so important to fit into your overall business model, right? Someone with $10 million is likely going to be a little bit more conservative than someone with $1 million that's looking to grow their base, their foundation. So these are just considerations, and the BOE is one of the great, one of the real kind of streamlined ways to identify if a property is going to fit your investing criteria. So hopefully that helps. If you read the article, the example I used is a little bit different than this, but it really doesn't matter. The principles are the same. And what you'll see, because in the example I used, I believe it was 6% cap rate and 4% debt. And what you're going to see is because that delta is so small that essentially your cash on cash returns are lower than the cap rate. And you'll see why in the example. So that's it for today. Hope this was helpful. If you have questions, by all means, let me know below, and subscribe to the channel if you're watching this on YouTube. And if you think someone would benefit from this, please share it with them. Okay, that's it for today. Talk to you tomorrow.